change, the financial media typically fall back on unverifiable psychological factors that really amount to throwing up their hands and saying, the stock market is a teenager. For instance, on August 31st, 1998, the 13th most extreme market move during the period from 1988 through 2012, the financial media attributed the 6.6% drop in stock prices to fears of turmoil in Russia and doubts about Asia. Blaming something on fear or doubts doesn't help. You can always blame a decline on things like that. And you can always attribute an increase to optimism. I want to know what caused the fear. What caused the doubts? What news do we have today that we didn't have yesterday? The lesson here is that attributing stock price moves to psychological factors isn't getting at the underlying reason for the price change. That means that we really don't understand the reason for the price change. We simply don't know everything about why stock prices move. We do know quite a bit, though. If you tell me that the market moved a lot today, then I'm betting that it'll move a lot tomorrow, too. Mind you, I don't know whether it'll move up or down, but I do know that volatile days tend to group together, and so do tranquil days. In this sense, market volatility is like the weather. If I asked you to guess the high temperature in New York tomorrow, your best guess is a little over 60 degrees. That's because over all 365 days, the average high temperature in New York is a bit over 60 degrees. If you're watching in July and today's high is 84, though, a better guess for tomorrow's temperature is the low 80s. And anyone who's been in New York in January knows that a guess in the 30s is more likely to be much more accurate in January. In fact, a good guess of tomorrow's high temperature is today's high temperature. If it's 85 degrees today, then the odds are pretty good that we can rule out temperatures in the 30s or 40s or 50s. High temperatures, and low temperatures for that matter, tend to cluster as weather systems form and dissipate. Market volatility is a lot like that. Highly volatile days tend to cluster with other volatile days, and calm days tend to cluster with other calm days. Here is the historical evidence. During the 25 years from 1988 to 2012, almost half of the 50 largest stock price movements occurred in just 1 year, 2008. 24 of the 50, to be exact, including the 7 largest. Just 2 of those 25 years, 2008 and 2009, produced 9 of the 10 most extreme market moves. If the big moves were distributed randomly throughout those 25 years, then you'd expect to have less than 1 of the top 10 in any 2 years. Yet 2008 and 2009 had 9 of the 10. Extreme moves seem to clump together. What's the point? Remember, when you hold stocks, you're holding risky assets that offer a particular mix of risk and expected return. Volatility clustering means that sometimes you're getting more or maybe less risk than you bargained for. That means you might want to increase your equity stake in periods of calm or take a little money off the table during unsettled periods. Notice that I'm not saying you should do this. I'm saying that it's absolutely normal to feel a little nervous during these volatile periods, and you might want to think about adjusting your portfolio if you're uncomfortable with how volatile the market happens to be. It has nothing to do with prices being too high or too low. It's the amount of risk you're taking that might motivate you to take action. If you do decide that you want to adjust your equity position depending on current volatility, be sure to be honest with yourself. We saw the historical record, right? Sometimes we saw big moves down, and sometimes we saw big moves up. Big moves up signal risk just as much as big moves down. Lots of people find it hard to take some money off the table when things seem to be going their way. That's okay. I believe that prices are pretty close to fair during periods of high risk, so you'll likely get fair value if you sell during periods of high volatility. If you do it, just do it with your eyes open. In our next lesson, we'll try to understand and answer an investment advisor's favorite question. Do you want to eat well, or do you want to sleep well? We'll learn more about the trade-off between the amount of risk you take and the amount of money you can expect to make. We'll also learn about diversification. That's about the closest thing to a free lunch you'll find anywhere.